Good afternoon, MMTs. What we're talking about is how that S&P got slightly above its 10-week simple moving average at 1675. This counter rally that happened in the first 6 days of 6 days, we've gone straight up from the lows of 16. When we called back here, we called for the 1630. This is that correction in August. This is that counter rally. So it's gotten about 53 points from those lows. It's very bullish. As we approach the major resistance level, we clearly stated that every selling that we've had in calendar year, meaning that we called for a correction in August and we got it. Now the bulls come back up from the original down move. That's the month of August, and here's 6 trading days of September. Monday and Tuesday were parabolically up, and the first 4 days of the month we went straight up here. So basically that S&P is above that 10-week moving average. We're going to see what happens when it comes right up here to that neckline, or where that reversal was, right at about 1700. What we'll be looking to do at that time, should we come up there and test that, we'll be looking at how to trade some of the S&P Index 500 1700 puts. They paid really good over here. They paid big money here, so we're going to look at repeating that process on the S&P bull rally, counter rally, right back up to its neckline up here. That's going to be that next area. Had a huge move up today. It was up 0.73%, up 12.28 to 1683.99 on the close. 2 days in a row. We will be taking a look here on the daily chart as well. One of the things that we're going to feature here along with this S&P is that when we had the last reversal that we called for, these contracts were on sale down here at the lows of $35, and they went straight up to $80 when we had that correction. That was a big move. Now they come from $80 right back down into this deflated area, and that's a $1,700 put right here. October regular $1,700 put that paid big money in that August reversal. What we are going to be doing is looking at repeating this trade. So when the S&P comes up to the neckline, let's say the S&P, it's a little bit overbought in my view. I mean, the S&P, when you take a look at the Standard & Poor and you take a look at the percent K, you're at 99% overbought with a lot of these equities in the 6-day bull rally, counter rally. That $1,700 put that we purchased back over here from that reversal down to that 1630 where we called where the support was, is now they brought those same contracts right back close to where our entries were, but 20 contracts paid over $50,000 here now, folks. They went up here to $80. So we're going to be looking at where that next wall of overbought resistance will come into play. Then what we're going to do, as you can see here, we're going to go back and buy the $1,700 put. There is a 1680 put regular that was $34.97. They got marked down to $27.70, down 19.2%. That means that the put side to the call side ratio is totally deflated as it once was over here. Okay, when we had the correction here. And right now I'm seeing a 99% overbought daily chart on the S&P. When I go to the weekly stat, it's above here. It's above here on that weekly, above that 10 week. So there's the neckline on the weekly, and on the daily, we're overbought. So we're going to be looking at where we get the wholesale prices so that when that bull rally falls from an overbought level, that we can buy wholesale again and have that glory on the pullback, because the call side is inflated. So the calls on the S&P are totally way up in here, and we're buying down here. Once again, I can tell you they made a big move here when we had that correction we called for August. This is the counter rally back to that bull neckline. So that bull caved in. The bear was in control. The bull has come back and stood up for itself, and it's coming right up to that wall of resistance. Once again, the 1700 regular put is all eyes. We'll be on that buying. Remember, when we're buying down here, we're buying wholesale. The risk is out of the trade. There's always risk, but we're removing that risk. So if he makes a lower low on these original contracts, we know where to price them. We'll price them at 32.50 tomorrow morning.